Now the week ends with most financial markets in the red, and a lot has happened. To discuss some of the week's market moving highlights, we are joined by Cruickshanks, who's Chief Economist at the SA Institute for Race Relations. Welcome, sir.
Thank you. Good to be with you, Gunther.
Well, Ian, I don't know where to start. Let's start with the rand, maybe. That was the first thing that happened this week. Hit an all-time low, recovered since then.
Yes.
Your thoughts?
I think it probably has, it's gone further than it deserved to. Yes, the fundamental data is poor. No, very poor. There's no doubt about that. But does it justify the rand blowing out to the extent it does, that it has? I don't think so at this stage. I think that we're going to see, it's got to what we would call in technical terms an oversold status. It's been sold down beyond the worsening fundamental economic factors. And I think maybe we see a little bit of consolidation, not necessarily a lasting improvement, but this is likely to be only temporary.
Yeah, but there's a bit of a self-fulfilling prophecy going on here. We've got credit default swaps hitting the highest since 2009 this morning.
And what does that say?
Weaker rand ahead?
Yes, what that says, that shows the opinion of foreign investors, international investors in the rand and in the whole rand arena. They don't like it. They'd rather take money out than bring money in.
Ian, we've had manufacturing numbers out.
Yes.
And one might get very excited to say, well, despite load shedding, we had an improvement.
Yes.
But then again, there's something further back one forgets about.
Yes, look, 5-6% year-on-year improvement. That's July this year compared with July a year ago.
Yeah.
But what we have to bear in mind, the exceptionally low base. July a year ago was the culmination of the strikes, both in the manufacturing and in the mining sector. So we were starting from that low base and then going back to normal. If you take that number out and annualize the following 11 months, then you find that the increase is not 5 or 6%, it's only 2%. So, I think we mustn't get carried away with one set of data.
Something else that was also concerning is Fitch.
Yes.
First decided to close the office in South Africa.
Yes.
Then they came out to tell us, well, just after Brazil was downgraded to junk status, South Africa, you better be wary.
I think so. So there are two warnings there. First of all, let's start with Brazil. Brazil getting downgraded to junk status. There's a lot of factors in common with South Africa's economy and the Brazilian economy, except the Brazilian situation is even worse. But that's where we could go to so easily. And what would it mean? It would mean that South Africa's access to foreign capital would be limited, and we may find that foreign capital that was already here was taken out, because it was in the situation no longer satisfied the investment requirements of these global asset managers. That would be very, very difficult. What would it mean? More difficult to find capital, operating capital for the company, for the country, and the cost of that would be much higher, because there would be higher interest rates to pay, and this would really mean any business had a higher basic cost of capital. Oh, that's a terrible situation. That we must remember that we're getting perilously close to it.
And what about Fitch pulling out? Some think it's quite sinister.
I don't think it's sinister. I think it's just a fact of the state of business in South Africa, the state of economic activity. There's not enough there are not enough corporates and state-owned enterprises and state enterprises that need ratings that justify 3 separate agencies. Don't forget, this isn't a free service. It has to be paid for. And I think
it's not cheap either.
No, not at all. And so dividing it up amongst 3 means there was that much less business to go around. We may find that we could even find that only one survived. I think probably S&P and Moody's will remain here, but it just goes to show that the economic activity in South Africa is dwindling. This is a good pointer to it.
Let's move on internationally and find out what it means for South Africa. Germany this week came out with some pretty impressive trade figures, unlike the rest of Europe.
Yes.
But then China disappointed everyone quite severely.
Indeed, and it raises a question here. Is China actually going to make a 7% growth rate? And the following question is, are we quite happy with the fact that in the previous decade or so they were growing at 10 to 12 to 14% per annum? Is that even possible? Now, that's a question we can't get answered very easily.
No.
However, looking at that 7% growth expectation, what we have to look at, we can judge by their imports and exports, the state of activity, the volume of activity in their economy, and is that going to justify a 7% growth rate? And I think there are serious questions there. What we're finding is that exporters, say exports of copper to China, the Chinese are saying, we've got nowhere else to store it. We have enough, thank you. What does that say? The utilization of a major industrial commodity is at a lower level. And I think what this means is they're going to want fewer imports. What does it mean to us? China takes 37% of our exports. Now, if we're finding that there's a question on the deliverability of 37% of our exports, boy, our trade account is in trouble. Another factor, a big warning as to where we are in global sectors.
But the Chinese and Japanese have both come out to say they're going to support more the economy with stimulus.
Well, yes, and they have managed it so far. But just look at the Japanese economy. Remember, they had 20 years from 1990 when nothing happened. It went sideways. Finally, they're flooding liquidity into the market. China seems to be following a similar sort of pattern. So maybe it will stop it worsening. Will it improve it? That remains to be seen.
Yeah, indeed. The jury's out on that one. Let's talk about now the big one that's coming up next week.
Yes.
FOMC meeting. Yesterday, jobless claims, when I saw the number, I thought, oh my word. There go emerging markets again. The rand is headed for the bottom. But what I didn't notice was that inflation data was rather dismal. And that's going to put a bit of a headache into Janet Yellen and her crew.
When you say rather dismal, it was even lower than had been expected.
Yes.
Yes. Now, what they're saying is the decision on whether or not the FOMC, the Federal Open Market Committee, raises rates or not, they keep on stressing data dependent. Two sets of data. One is unemployment, which is down at a very low level, now at about 5.2%.
They say it's full employment.
Yeah. Yes. Well, all those who are not working are those that don't want to or else are unemployable for whatever reasons.
Yes.
Now, that could be training, education, whatever. So that's the one factor. But the other factor is the state of activity in the market, the inflation rate. What it says is that demand isn't enough to pull prices up, to push inflation. So maybe we're getting waylaid here somewhere. Maybe they're saying that if the economy doesn't grow vigorously and inflation doesn't go up as a result because of increasing demand, then there may not be a necessity to act just yet. And if they do act, we're saying the base rate would go from 0 to 0.25%. Perhaps they'll say we don't want to give too much of a fright. Let's only put it up by 0.1%. Then there's another problem. You know, is this a good or bad omen?
Do you think they will move?
Perhaps it's going to take much longer.
In your opinion, do you think they'll move?
I think that they won't, because if they say it's data dependent, there are two sets of data, and only one, that is the unemployment level, says that they should move. But the cost of labour, the unit labour cost, has not in fact shown any inflationary tendency yet. So, you know, they can justify not moving, especially with the state of the global economy slowing.
Ian, we've got about 30 seconds left.
Right.
And when these Chinese fallout happened, a lot of people started saying, well, this means the Fed is not going to hike. I want to know what China has to do with the Fed when you just told us that it all depends on American data.
Well, absolutely. However, it also depends on the state of Chinese economic activity. That is slowing. I think there's no doubt about that. And that just may make the Fed say, well, for the rest of the world, it would be bad news at the moment. Let's not add on to any more of that for now.
Okay, our currency, your problem. Thank you for your time, Ian Cruickshanks.
Thank you.
Chief Economist at the SA Institute for Race Relations. Now let's move on. Steel Federation SABC says the